I think the biggest challenge with IRR is that it gets confused with annualized return. And if you look back at the stock market, and if somebody says the stock market's up 20% year over year, and they have a private investment that generated a 20% IRR, those aren't the same things at all. They're not even correlated to one another. You can quantify annualized return. If you have $1 million in the stock market and it's up 20% in a year, then you know that you've made $200,000. If you've made a 20% IRR on an investment, you can't quantify that. There's a saying in our business, IRR can't be spent, and that is the definition of it because you don't know how much it makes. So I've seen investments that have 17, 18% IRRs, which sounds great, but they haven't really built any wealth through those investments. And there was one fund manager in particular who I was talking to about a private investment opportunity, and over 6 years, they had produced a 17% IRR, but a 1.3 multiple on invested capital because of the timing of those cash flows coming in and out. And when you look at that, over 6 years, a 1.3 multiple on invested capital, and what that means is if you put in $1, you got back $1.30. That's really what you want to look at. You want to look at the multiple on invested capital in context with the IRR, because ultimately what you want are managers who know how to not create IRR that can be manipulated. You want managers who can create wealth, and you do that by multiplying capital. So looking at those two things together in context with one another is really, really important.